We're going to get rolling here today, and we're starting off this week with a little bit better trade in the grain market. And the first thing I want to really take a look at here today with the March contract going off the board, and this is yesterday's closing prices, is whether if we have carry in the market or if we're inverted. Inverted means that the March contract is greater than the May contract, and carry in the market is the opposite side. Here in front of us on this chart, you can see what has red on it is markets that are inverted. We got corn, soybeans, KC wheat, and soy meal that are inverted. And that tells us that this is a strong market as you have March greater than the May contract in here. And we think that is really positive for the markets and indicates stronger domestic demand. So this is something I think is interesting in here, especially with this March contract going off the board. The next thing we want to take a look at is here's world corn futures prices over the last 6 weeks. You can see on February 1st here, U.S. May corn futures are around 679.5. Yesterday they closed at 613.5. We're down almost 10% in the last 6 weeks. When you look at EU, though, they're only down 5%. The Brazil market is down 2%, and the Chinese corn market is down less than 1%. Our point here is that the U.S. corn market is probably overdone on the lower side. The other thing today, it was announced that China bought some U.S. corn. That's a positive indicator. So considering corn's inverted, U.S. corn has been down so much compared to the world market in here. To us, we look at there's some good support. Don't get too bearish on the corn market right now. Here on this chart, we have corn versus Chicago wheat on a weekly basis. And our point here is when you look at corn versus wheat, wheat is actually looking fairly cheap compared to corn. The March contract is going to go off the board at around a 45-cent a discount, corn to wheat. Where you look at the May contract, it's around 75 cents. Historically, though, that is tight. Our viewpoint then is telling us either that wheat is too cheap, okay, or corn is a bit high. The other chart on a spread that's interesting is when we look at corn versus oats. As you can see right now, over the last 12, 13 years, very seldom do we have corn trading at a 275, 280 premium to oats. Again, our argument then is if we think corn can go up, oats sure looks cheap relative to this corn market. As we get to the next slide in here right now, this is on the beans, and our top slide is a July bean chart. That light red line in there is a price on February 28th, and the bottom chart is the July-November bean contract. We think that this bean market, okay, long term could be a little bit more negative with normal production here in the US. But what's really thrown a wrench in here in this market recently is a big drop down in the Argentina crop. Even though bean futures have been flat over the last couple of weeks, we're seeing bull spreading in futures. Again, that's another sign that there's probably some near-term support underneath these markets. As we want to get things wrapped up here today, we're just kind of shifting our bias in here in the near term. We think the risk to reward is favoring a little more of a bullish position. When you get towards new crop corn at 650, 660 and look ahead the next 3 or 4 weeks, it just seems like a 30 to 40 cent bounce might occur a better chance of occurring than a 30 to 40 cent break. Corn is very competitive on the world market. Where corn may have issue on the export side of it, it's competing against some wheat. This Argentina crop is getting smaller and smaller. I mean, you're looking at it down 50% compared to trend line. This is a historical drought. Considering our crops in the U.S., the bean yield was only down 20% in our drought years, and the corn crop down around 30%. Everyone talks about a big Brazilian crop. They do have a big harvest, but it is pushing almost to the 50% level. That's slightly behind normal. Where we bring this up is historically in the U.S. when our harvest gets to 50% completed, we look for seasonal lows to be in place. Should we apply that to Brazil as well? This week, we got the outside markets, some small bank issues adding some additional volatility. And that's the thing you've got to see is this volatility is going to continue in here, not only in the outside markets, but in agricultural markets as well. Have a great day.